Welcome everybody to the next video of this A to Z Forex program. We're getting straight into some of the assets that we actually trade. So we're getting a little bit more specific now with strategy and relevance in trading, I guess. You've learned a lot of information on the backstory of the foreign exchange market, what it actually is, the main and major market participants, macro fundamentals, so what actually drives price and why. Now we're looking at the actual assets that we're trading and the reason why we trade these certain assets as well. But what you're going to get an understanding of in this video is what actually happens when you press buy and sell, and also some things that you need to look out for if you're swing trading, you're taking positions over 24 hours. So it could be a day and a half or 2 days or anything longer than that. There are some implications for that trade that you need to be aware of. So let's get straight into it. What are the major and minor currency pairs? So we have major currency pairs on the left and minor currency pairs on the right. Major currency pairs are the most heavily traded pairs in the foreign exchange market. And usually it's because the United States dollar is involved in nearly every international transaction. And these pairs have the highest liquidity, the tightest spreads, and the smoothest price action. That's why we like to trade it, because it's easier to trade, I guess. I want to be very broad with that word, because it isn't necessarily easier than minor currency pairs, but because the major currency pairs display cleaner price action, they have tighter spreads, it's more enjoyable and it's easier to enter positions and to analyze the charts. So some of the major currency pairs include the Euro/USD, USD/JPY, GBP/USD, USD/CHF, USD/CAD, AUD/USD, NZD/USD, etc., etc. What can you guys identify in this list here that is consistent throughout all of the assets? I'll give you a little bit to think about it. Essentially, you can see that all of these assets have the United States dollar as either the base or the quote currency, and that's what makes them a major currency pair. And for those that don't know, the United States dollar is the world's reserve currency. And as we talked about in this paragraph, it's why we like trading these assets in particular. Now, minor currency pairs involve the currencies of major economies other than the United States dollar. So some of the commonly traded minor currency pairs are Euro/JPY, Euro/GBP, TGR, I think trades Euro/GBP, GBP/JPY, NZD/JPY as well. Miners tend to have slightly wider spreads and lower liquidity, but they can also offer unique opportunities as well, especially when the dollar isn't the main driver of the movement. So understanding which pairs are major and minor helps you know where the liquidity is and the opportunity is, when the best trading times are, and how different economies influence price movement. So you could, for example, you have a fundamental analysis for Euro. Euro and GBP, very similar to each other. They seem to correlate with each other quite a lot. So trading on that pair can be quite beneficial at times when there's the macro to back it. So understanding currencies, why is it important? Now, every single trade you open involves two currencies, one you're buying and one you're selling. Each of those currencies is tied to an interest rate set by its central bank. This is what I was talking about before when I said, if you're taking positions for longer than 24 hours, this is the stuff that you need to know, which most gurus who sell you courses won't tell you. The difference between those rates is what creates what's known as the carry. So traders like Tory Trades that sell courses and have mentorships and all that crap, they don't teach you any of this stuff, yet they swing trade. So their shit is just completely crap and it's not relevant to you guys. Even if you're a scalper, it's still good to know this stuff, because I have a strategy where I scalp and I have a strategy where I hold positions within a 1 to 3 month time horizon, and I manage a small portfolio. When you hold a position overnight, your broker either pays you or charges you interest based on that rate differential. We talked about in previous videos what differentials were, and now we're getting a little bit more specific. This daily interest adjustment is called the rollover or swap. And how this is relevant to you, we sort of already touched on that, but it affects your net returns, especially if you swing trade or hold positions for several days. You could be paying a lot in interest that even though you're technically in a positive outcome for that trade, your profits get eaten away by the interest that you pay. It influences how you decide on what currency pair to trade. Not all trades are created equal once carry is considered. It's part of professional awareness and being a good trader. Understanding how market functions beyond just price action separates serious traders from just casual retail traders that everybody behaves the exact same. Everybody knows the same information. Everyone knows the same strategies. It's all recycled rubbish that one guru teaches another guru, which teaches another guru, which teaches another guru, and they just tag people along. It's just shit, man. Absolute shit. So I'm really glad that you're watching this video. I'm not saying I'm a bloody saint or anything, but what I am saying is this free information that I'm giving you guys is actually crucial. It is relevant and it does have a direct effect on your trading ability and career overall. Now, what is a carry and rollover? Now, before I begin this lesson, it's important for you to first understand the definitions of both a carry and rollover. And you'll need to refer back to these definitions while you're learning the process of how a currency is bought and sold. So make sure to write both of these definitions down or take a screenshot or whatever you want to do, timestamp this wherever it is up, whatever time the video is at right now, write that down, whatever you want to do. But just make sure you understand these definitions. So a carry is the difference between how much interest you pay versus how much interest you receive. It's that differential. Whereas the rollover is the daily interest you pay or receive on a day-to-day basis. So how does buying and selling actually work? So not having a thorough understanding of leverage, margin, carry, and rollover will create more problems than it will successes. And again, like I've spoken about before in this video, most retail traders don't know this stuff. So they could be trading over a long time horizon and they have no idea why their profits are getting eaten away. They have no clue. So you're learning this right now, which is awesome. Most traders will leave trading positions active whilst making money on the fluctuation of the exchange rate of the asset, meaning they initially think their trade is successful without knowing that they are paying interest per day to run the position. So not knowing this can cause you to be wiped out by a margin call when price runs against you. Retail traders make the huge mistake of not realizing that more leverage doesn't mean more volatility if the asset class that they're participating in. The percentage return of an asset is an element of the asset's volatility and changes over time. The only volatility when increasing or decreasing your leverage is in your profit and loss, or P&L. The volatility in the asset you are choosing to trade in creates opportunity, not the leverage or margin requirements. I hope that makes sense to you guys. So people think that trading with more leverage and more capital and risking more is going to make them more, when really you need the volatility, the opportunity there in the asset that you're trading. So moving on to the next slide, when taking either a buy or sell position of a currency pair, you are going long one currency pair and financing the purchase of that currency by shorting the other currency. For example, if you were to take a buy position on GBP USD because market structure is bullish, you would essentially be buying GBP whilst financing USD. This process occurs automatically, which is why many retail traders don't understand the process because they feel like they don't need to understand it when you do. During the process of executing this position, the low yielding currency is being borrowed, which is USD in this example, and the high yielding currency is being lent or invested in, which is GBP. What is actually happening when borrowing a currency pair is the act of selling the currency, USD in this example, short because you don't actually own it. You are borrowing the position and paying the interest rate of that country to attain the position. I hope that makes sense now. The interest rate of the currency fluctuates, and the money that was financed to obtain that position is used to go long on the high yielding currency, which is GBP in this example. So I hope that last paragraph summed up a lot of probably questions that you had in your head from previous slides and the start of this slide as well. And again, if you have any questions, let me know in the comments section below and I'll be more than happy to answer. So let's give a profit example going long on GBP USD. So you are betting on the direction of price. So if price rallied to the upside, the low yielding currency, which is USD in this example, would be sold short and the high yielding currency would be bought long, which is GBP. The profit you acquire will be based on how much interest you're paid due to the increase of the exchange rate of the high yielding currency. And the opposing example is at a loss if you're going long on GBP USD. So if you were still to take a buying position on that asset, but price moved to the downside against you, the low yielding currency would now be GBP and the high yielding currency would now be USD. It's switched. The capital you lose will be based on how much interest you now have to pay due to the decrease of the exchange rate of the high yielding currency instead of the interest that you receive. Now guys, I'm going to jump onto Excel and show you this broken down on a quantitative basis. It's going to be a little bit of information for you to take in. Watch this video as many times as you can. And as always, if you haven't liked this video already, please make sure to like and subscribe so you can stay tuned for future videos of this Forex program.
Alrighty guys, straight onto the Excel spreadsheet now. I know this looks pretty confronting for you guys, but every Excel spreadsheet usually does. But it's actually a lot simpler than it looks. Everything that is in red is essentially a variable, so you can change it. All of the calculations, the formulas have been done for you. So all you need to do is replace the inputs that are highlighted red, and the variables will change. So starting off with the left, obviously in this top table here, this is assuming zero leverage and zero margin, and the interest rate we are assuming that is paid 365 days of the year, and the exchange rate of the currency is 0.94512. Right, so let's change the currency A to, we can use GBP, and we can use USD here. So that is the example, the currency pair that I usually use in most of my examples, mainly because I trade it the most. So off to the left here, we have the deposit rate and the lending rate. So the deposit rate is essentially the rate at which you acquire the asset. So the time that you actually execute your trade on GBP USD. The lending rate, which is essentially the rate at which you cover your position. Remember, for every buyer there is a seller, for every seller there is a buyer. So when you close your position, someone else is essentially covering that position. So the position that you lent, they are now acquiring that specific asset at a different interest rate and exchange rate. Now beneath the deposit and lending rate is the different lots. In this video, I will mainly be talking about standard lots. So back to actually talking about the deposit and lending rate of this currency pair. In this example, we have the deposit rate of GBP at 1% and the lending rate at 4%. And with USD, we have the deposit rate at 7% and the lending rate at 12%. These will be changed. You will put the deposit and lending rate of whatever currency pair that you're trading from the sheet that's given to you by your brokerage platform. So in that example, we've got 1%, 4%, 7%, and 12%. The differential carry is essentially the difference between the deposit rate of one currency and the lending rate of the other. So this, for example, in this column, this is essentially if you were to buy GBP USD, so you would go long on GBP, which is currency A, and you would short USD at the exact same time, which is currency B. And the difference is 12% minus 1%, the deposit and lending rate. And considering, obviously, this is a negative carry, so minus 11%, you will actually be paying over the course of 365 days. So every year you will actually be paying 11,000 units in currency every single year. So and on the other column here, this is the blue column. This is if you were to actually short GBP USD at this present time with the current deposit and lending rates of both assets. So if you were to to long actually currency B, which is USD, and short currency A, which is GBP, the difference is positive 3%, because remember, you are essentially minusing 4% by 7%. And how much you would be getting paid in terms of interest every single year would be 3,000 units in currency, and that's based off one lot, which is 100,000 units of currency. Now, the rollover rates are essentially the daily interest you'll be paying or getting paid. So from this example, if you were to go long on GBP USD, you would essentially be paying 31.8869 units in currency every single day. And if you were to actually short the exact same currency pair with the present deposit and lending rates, you would be getting paid 8.6964 units in currency every single day. So play around with that top table there. Remember, the variables that are highlighted red can be changed to allow different inputs. So moving on to a very, very similar table, but actually considering margin and leverage this time. So let's assume that you have a trading account of $30,000. On the left column here, underneath the margin requirement, we have all of the different percentages. So just say it's 0.5% margin requirement at 200 to 1 leverage, which is the following column. Your exposure based off a $30,000 trading account with 0.5% margin requirement and 200 to 1 leverage, your exposure would be 6 million units of currency, which is equal to 60 lots, standard lots. Now, this is still following the exact same example above, but your daily rollover rate, if you were to go long on GBP USD, you would be paying out 1,913 units in currency. Whereas if you were to go short the exact same currency pair at the exact same deposit and lending rates with 0.5% margin requirement, 200 to 1 leverage, and a $30,000 trading account, you would be getting paid 521.79 units in currency. Now, what's highlighted in red on both columns here is the dangerous zones that essentially we don't want to be trading with these margin requirements, this leverage on this trading account size, because that's when the risk of your account essentially being wiped out becomes quite high. The range that we actually want to be looking at is this highlighted column here, the blue, where the blue meets the green. Those two columns are essentially the safest zones that you could be trading with at this specific deposit and lending rate, with this margin requirement, account size, leverage, etc. So just say if we were to with a $30,000 account size, 20% margin requirement with 5-to-1 leverage, your exposure would be only 150,000 units in currency. Your standard lots would be 1.5. How much you would be paying in interest every single day is essentially a lot lower than the first example I showed you. It is only, you would be paying 47.83 units in currency, as opposed to 1,913.22 units in currency from the first example, sorry. So we can already see an improvement in the numbers there. So, and as well as if you were to go short this exact same currency pair, the daily interest that you would be getting paid is 13.4 units in currency. Even though the numbers are essentially less, it is a lot safer. Remember, trading is all about consistency as well as profitability. With these types of numbers up here and variables, this is where you start to get the boom and bust cycle of your equity curves, of your profit and loss. So please avoid the highlighted red areas and focus on the middle area here where the blue meets the green. Remember, what's highlighted in red are essentially variables that can be changed. So play around with this table using a couple of examples of currency pairs that you are essentially trading now.
So you've just watched that Excel example and you're wondering where you find the interest rate of a currency. It's spelled incorrectly, but you know what I'm talking about. So you can find the currency's interest rate on the brokerage platform that you trade with. You will receive the rollover rates in a table, which your broker must provide you. They have to, because the broker has a regulatory responsibility to provide you this information. You may just need to ask for it, but if they deny it, another big red flag. We've spoken about what makes a good broker and bad brokers. If they don't give you this information, it's just blatantly illegal. I hope that sums up everything in this video. I hope that sums up your understanding of currencies. What actually happens when you're pressing buy and sell, the behaviors behind it, and some of the implications that you need to understand on holding positions for a long period of time. A lot of gurus aren't going to tell you this information. They're not going to teach you this because they don't even know it themselves, because most of them are uneducated, unfortunately, but they're making an absolute killing from selling courses. So look, I hope this video affected you in a positive way and you learned something valuable. And in future videos, you're going to continue to learn some more stuff. So if you are new to the channel, please make sure to subscribe, hit that like button, comment any questions you have down below, and thank you all for watching. I will see you in the next video. Thanks, guys.